Welcome to the UnEarthed Financial Weekly Observer Market Report. It's most certainly been a very interesting week last week with up to or over 3% to even almost 4% of a drop in across the financial markets globally. Starting as usual with the global indices with the weekly chart for the ASX 200. You can see that the this weekly bar here is actually just yesterday's bar, so we've even had a further drop in the market. But last week we actually had a range of 214 points in which the market dropped significantly, which was a 3% fall for the ASX 200. But it most certainly gave in to, I'll just remove this horizontal red line at the moment from there. And you can see that it was almost smack bang on the 4962 level, which is a level I've been speaking about since before October last year. As the market rose up here, we did find a reversal near to that level, but it's happened again, but even more prominent to that level. The FTSE is the same. It's actually finding resistance at an old high here that was back in 2008. So it's reversing off that high, and it's also near its Fibonacci level, the 38.2%. It's actually overshot it a little and then reversed. The Nikkei has come up just slightly above its old high back here in August 09 and has reversed back down, is finding weakness similar to the other markets. I do apologise, I was just showing you the Nikkei daily charts there, so just flicking over to the Nikkei weekly chart, you can see here that we have a fairly weak bar last week. It was actually 3.6% that the Nikkei weakened, and that is relatively close to the Fibonacci 61.8% reversal level. The S&P 500, the US market, has a very, very strong reversal bar for its weekly bar last week, and that was around the 50% Fibonacci level as well, similar to the Australian market. Now going to the Australian market, you can see, on the daily chart, looking back, the movement that we've seen over these last 1 to 2 weeks has been more of the type of behavior that you see at the end of a trading cycle, and that's where we see a lot of sell-off, which can result in panic selling as well. So it's just a natural retracement in the market where all of a sudden there's more sellers in the market than there are buyers, and the prices move down. Now we did see this back from the October high all the way down until the low of November, but then that did seem like the end of the trading cycle, which was coming into, it was just falling a bit short of our time frame here where we were expecting a significant low, and which is, sometimes you'll find it falling short or actually extending over that time frame around about 10 to 20% of the time. But what made me quite alerted to the fact that this is probably not the actual trading cycle low was that there was not a strong move out of it. It was initially, but then that tapered out and actually moved sideways for a very significant amount of time. It was actually around about from the end of November till around, it was even sideways till possibly around about this point here, until it broke above that sideways, which was the end of December. So it was quite a large amount of time of the market moving sideways, whereas I've mentioned before that typically the start of a primary cycle or trading cycle is very, very, very strong coming out of it. So this was not the typical type of movement. So to receive this pullback here now in the market is not uh, necessarily a shock at all, especially that it did come within 7 points within the 50% Fibonacci level and then reverse off that very significant level or price level. So it will be quite interesting to see if this market is changing. The last couple of cycles have both been bull cycles since the March 2009 low. So it will be quite interesting to see whether or not we are changing from bull to bear, or if this will just be another significant pullback, starting us off into the new trading cycle, into the next bull cycle. So of course time will only tell, and rather than guessing what it's going to be doing, we'll just trade it the way it's going. We did enter a really nice short trade here on the ASX 200, and the market actually got us in a little bit earlier, which the cash market hadn't actually reached our entry point, but it did within the CFD market, and that trade only got stopped out by a few points before plummeting into our direction. So that was incredibly frustrating. The same thing happened to us on the FTSE trade as well. We had a short trade on the FTSE. We'll go to that chart now. Same thing with the FTSE. We actually got in a nice short trade right here. It executed, went against us initially, up to here, stopped us out only just by a few points before plummeting into our direction. And it's like with the ASX trade, it would have been over 266 points in profit, where the FTSE would be over 360 points in profit. But instead, both of those trades actually resulted in losses because their stop losses were hit and a loss was realized. So it doesn't necessarily matter. You can get the direction right and then you can still have a losing trade. And that is one of my most frustrating components to trading. You try and put your stop losses at a safe spot that should the market actually reverse and go against you, which is, that's the part of trading and will happen to you. So of course you don't want to have your stop losses too far and have big losses if you're going to get it wrong, the trade wrong anyhow. But there are going to be those times when you have the trade right, and which is obviously hopefully most of the time, and it's going to go against you for a short time, stop you out, then go into your favor.